Hi, I'm Ray Meadows of Berkeley Investment Advisors, and I'm here with my friend Hiromi.
Hello.
And we've been talking about mutual funds and exchange traded funds, and they own portfolios of stocks and bonds. And so now I'm continuing that discussion, so he's going to ask me some more questions.
I don't get it.
What don't you get?
What is the difference?
Stocks and bonds, okay.
What is the difference?
This is it. Turns out this is a very hard topic. I used to think it was easy, but no, I'm not so sure anymore. So let me start with bonds. A bond is, let's just talk about the money piece. Mm-hmm. So the money piece is, if you buy a bond, you're basically loaning the money to a company, okay? And then they're going to pay you interest. So every 3 months, they're going to pay you, or 6 months, they pay you some interest. And then at the maturity of the bond, at the end, it could be a year, it could be 2 years, it could be 5 years, whatever. At the end, they pay you back the money that you loaned them.
So am I making money?
If they pay you back, yes.
Okay.
So
with interest?
Yes, they're paying interest along the way. So for example, you might lend a company $1,000 and they pay 5% interest each year, and then in 5 years they pay you back the $1,000. Okay, so that's basically what a bond represents. But a bond is actually a security that you can trade. So it's a piece of paper that says I owe you $1,000 plus interest, and in the market you can trade that with someone else. So
it's a paper?
Yeah, well, it used to be paper. These days it's electronic.
So it's just like making a contract?
It's basically a contract, yes, and you're trading the contract with other investors. So you could, if you wanted to get your money out earlier than 5 years, you could sell it to another investor. The thing is, they might pay the exact amount of the money that's owed you, or they might pay less, or they might pay more. So the price between now and the date when it gets paid off can fluctuate. It doesn't have to be exactly what the principal is, because you're just trying to negotiate with someone out there to buy the debt from you if you want to get your money back. So that's what a bond is. It's a contract that pays interest and then pays back the principal at maturity, and it trades in the market like a stock. Okay, which brings me to stocks. What's a stock?
It's a stock.
A stock is not money that's lent. A stock is money that's invested in a business. And that business can have profits, which would be good, and then you'll probably make money on your investment. Or it could be invested in a business that's not so good, and they lose money, in which case the stock price might go down. So in the end of the day, you're owning one share of some large business. So for example, you could buy a share of Walt Disney Company, and if Walt Disney has a really good year and a lot of people go to their parks and watch their movies and they make a lot of money, then they will pay some of that money out to their shareholders. That's called the dividend. And then you're all happy, and then the more dividends they pay, the happier people get about owning that stock, and other people will want to buy your stock from you. That's when the stock price goes up. On the other hand, if they have a really bad year and their movies all flop and no one goes to their parks and they lose money, then they're going to cut their dividends down. People will be unhappy. They won't want to own their stock. Everyone will be trying to sell their stock to someone else, and the price goes down. So that fluctuates a lot, and the only way you get your money completely out is to sell the stock. You can't wait until it matures like the bond and get it back for sure. You just have to find another investor who wants to buy the stock. So you have to hope the business does well. So that's the difference between stocks and bonds.
Stocks, you can lose money.
Yes, definitely you can lose money. Or you can make a lot of money.
Well, I guess both ways you can lose money is good, right?
Both ways? What do you mean?
Bonds, too.
You can lose money in bonds. It's possible.
Yeah.
Sometimes they don't pay you back.
Yeah.
But
safer
it's more, it's safer
with bonds.
generally, especially if you think about what we talked about before. If you're buying a whole portfolio, it reduces the risk of having individual bonds and individual stocks. So really that's the way to go. But at the end of the day, stocks are ownership in a business, and if the business does great, you do great, and if the business does poorly, you do poorly. Bonds, all you need is that the business makes enough money to pay you back.
With stocks, you can't hold, even if it's going like...
You can hold it for as long as you like. You can hold it.
That's not a good idea if it's not doing well?
Well, it depends. It totally depends, because when it comes to stocks, you have to... That's why I don't recommend most people buy individual stocks, because really you have to understand the business well enough to know, is the price that I'm being offered in the market, is that a good price or a bad price? So you have to understand that if you're going to buy individual stocks. I'm just explaining that how stocks work, so you understand what's the difference between a stock mutual fund and a bond mutual fund.
Okay.
And I recommend that you stick with mutual funds.
Back to the mutual funds.
Just understand, bond mutual funds less risky than stock mutual funds.
Okay.
Okay, that's it for today. Thank you.
Bye-bye.